Good evening and welcome to our market briefing. Let's start with yesterday's closing numbers. The Nasdaq closed at $655.11. The S&P 500 ended the session at $711.21. The VIX index, which we watch closely as a measure of market fear, rose 2.22% to hit 19.34. That is a level that deserves our attention. The 10-year Treasury yield held steady at 4.30%. The dollar index DXY was at 98.72, still hovering near its 18-month low. On the commodity front, WTI crude oil fell 1.06% to close at $93.18. Spot gold continued its upward momentum, gaining 0.53% to close at $4,746.90. That remains near historic highs. Bitcoin slipped 0.9% to $77,714.10. So what is the market telling us from these numbers? We are seeing clear divergence and a shift toward risk-off sentiment. The VIX is creeping toward 20. Gold is at elevated levels. Bitcoin is falling. These signals all point to capital flowing out of risk assets. But here is where it gets interesting. Crude oil prices are declining, which suggests that geopolitical risk premiums are easing. That is providing some relief on the inflation front. This creates a major point of contention in the market today. On one side you have risk aversion pushing investors into safe havens. On the other side you have falling oil prices which should be supportive for equities. These two forces are pulling in opposite directions. Our call for today is a choppy session with a downward bias. We assign a probability of 65% to this scenario. The market lacks a clear catalyst for a directional move. We expect intraday volatility to pick up but with the overall center of gravity moving lower. The capital flow picture is quite clear. Money is rotating into gold and other precious metals as safe havens. At the same time we are seeing outflows from Chinese A shares and crypto assets. The dollar index languishing at 98.72 tells us that smart money is also avoiding dollar-denominated assets. Let us break this down by asset class. For U.S. equities, the VIX above 19 is the key headwind. It offsets any positive signal from lower oil prices. We expect both the Nasdaq and the S&P 500 to face selling pressure. The market is waiting for a clearer catalyst. For Chinese A shares, foreign capital outflows combined with shrinking trading volumes are two negative signals. The Shanghai Composite below the 4,100 level needs more time to build a base. Bitcoin falling below $78,000 confirms the current risk-off tone. In commodities, gold remains strong thanks to a weak dollar and safe haven demand. Crude oil on the other hand faces downward pressure as geopolitical risk premiums fade. We see two main trading themes for today. The first is buying gold and non-dollar currencies to hedge against dollar weakness. This trade is supported by the dollar index at 98.72 and gold holding above $4,700. The probability of continuation is high at 80%. The second theme is reducing exposure to high beta tech stocks and rotating into defensive sectors like utilities and consumer staples. This is driven by the VIX rising toward 20 and risk indicators like Bitcoin weakening. The probability of this trend continuing is around 70%. There are a few key battlegrounds to watch today. First, can the VIX hold above the 20 level? If it breaks above 20 and stays there, it could trigger programmatic selling and accelerate losses in U.S. equities. Second, watch the 10-year Treasury yield. If it breaks below 4.25%, that would reinforce recession fears. That is positive for gold but negative for stocks. If it bounces back above 4.35%, that could reignite concerns about the Fed staying tight. We also need to flag some risks. If a Fed official delivers a surprisingly dovish statement, the dollar could accelerate its decline. That would temporarily boost risk assets and invalidate bearish positions. On the flip side, if Middle East tensions escalate, crude oil could rebound sharply. That would overturn the current market assumption that inflation pressures are easing. Given all this, our recommended strategy for today is hedging. The signals are mixed. Bulls and bears both have arguments. A hedging approach is the most prudent way to navigate this environment. We suggest establishing long positions in gold or inverse dollar ETFs while also buying put options on the S&P 500. If the VIX breaks above 21 intraday and the S&P 500 confirms a break below $710, you can add to your bearish hedge. If the VIX falls back below 18 and Bitcoin reclaims $78,500, you should reduce your short positions. Your stop-loss condition is if the VIX drops below 17 while all three major U.S. indices rally more than 1.5%. That would signal a strong reversal in risk appetite and all hedges and shorts should be closed immediately. Let me give you some verifiable predictions. First, the S&P 500 will trade to an intraday low below $708 today. Probability 65%. Second, the Shanghai Composite will close lower today with trading volume below the previous session. Probability 70%. Third, Bitcoin will not be able to reclaim the $78,000 level within the next 24 hours. Probability 60%. Fourth, COMEX gold will hold above $4,720 over the next 24 hours and outperform WTI crude oil. Probability 75%. Fifth, the dollar index DXY will test the 98.50 support level within the next 24 hours. Probability 70%. Our overall probability assessment for today is 20% for an up day, 50% for a sideways session, and 30% for a down day. The bottom line is this. The market remains under pressure in the near term. Risk aversion is the dominant theme. Investors should use hedging strategies to navigate the volatility and focus on opportunities in gold and defensive sectors. Stay cautious and stay nimble.